Hello and welcome to Money Matters. Coronavirus is again putting a damper on the opening days of a new year, and central banks are expected to confront another contagion, inflation, which has been ignited by supply bottlenecks and labor shortages. Investors will have a tough time navigating this ever-changing financial landscape.
It was hoped the launch of a global vaccine drive would cut short the pandemic and allow a return to normalcy and a recovery of the global economy. We came close, but the outlook for 2022 was thrown into uncertainty again with the emergence of a new variant of the virus, Omicron. Investors rushed back to their models to recalculate forecasts, and much like the inoculation drives at the beginning of 2021, governments began urging people to get booster jabs. Can we emerge from the pandemic in 2022, or are we trapped in a perpetual state of déjà vu? In Hong Kong, the continued fight against COVID in 2022 will dominate the political and business agenda.
Independently, Hong Kong has little decision-making ability these days. So we are part of the mainland, and as long as the mainland's policy is zero COVID, Hong Kong will have to stick with that. Like it or loathe it, it's just the reality. But 30-day quarantines and the rest are driving business out of here. Even myself, I run a regional business between here, Singapore, Malaysia, and the rest of the region. I've had to distribute people around different countries. I can't go and do a one-week assignment and lock everybody up for 3 weeks when they come back.
Vickers says foreign companies from the US, UK, and Europe have looked ahead at the still tense relations between China and the US and have been peppering him with questions about the risks of walking through a possible legal minefield in compliance with both Chinese and US law.
Foreign companies, so from the US, the UK, Europe, are quite concerned about compliance issues. For example, sanctions and counter-sanctions, whether or not there'll be a will Hong Kong pass an individual anti-sanctions act, which would be very problematic. I think common sense kicked in just before it was due to happen this year, but clients are very concerned about that. Otherwise, they'll be banks, for example, could be given a clear instruction by the US to do A, but by the Chinese authorities to do B, and here you are based in Hong Kong, you could be pulled in either direction.
Overseas investors will continue to wrestle with the ever-developing regulatory surprises that Beijing springs on the mainland technology sector. In 2021, the strongest asset classes were US stocks and cryptocurrencies. They could carry on the momentum in 2022. But the prudent strategy would be to allocate only 5% of a portfolio to the digital asset. It's a different story for US stocks.
If you allocate asset into US stocks, I think probably you need to differentiate the individual stocks. For bigger caps like Apple, Amazon, Microsoft, or even Nvidia, I think you can put a little bit more into this kind of big stock. But for the smaller ones, I think you have to have a diversified portfolio. Probably you need to have a higher number of stocks to lower the risk.
Alex says he'll continue to remain underweight in Hong Kong stocks.
Many consumers actually may slow down the purchases. Generally, I think you should continue to underweight Hong Kong stocks. But for Hong Kong stocks, probably a few sectors may outperform. First of all, environmental related, like electric vehicles or those new energy stocks.
Hong Kong-listed Chinese consumer plays will also be a safe bet, as they are less affected by policy changes in Beijing. Utilities and big exporters that are sheltered from policy risk would also benefit from the expected shift out of mainland property assets into equities. In the property sector, events in China may have an impact here in the Hong Kong property market. Analysts look at Beijing's measures to dampen the real estate market amid the debt crisis among large developers such as China Evergrande as one big reason why property in Hong Kong may see a boost.
We can only expect that why the people will still consider investing in the real estate market. In Hong Kong, I think the only reason is about, say, the inflow and outflow freedom of the cash right here, and the liquidity of the real estate in Hong Kong. Compared to mainland China, there's less restrictions on the home market. The only thing is about the stamp duty, especially like the double stamp duty for the buyers outside Hong Kong or for the overseas buyer.
The prospect of interest rate increases by the U.S. Federal Reserve will have little or no impact on the sentiment in the local property market. Right now, most mortgages are based on the HIBOR interest rate. Borrowing for a 300 to 700 square foot flat will run around 1.3%. Even if the Fed raises rates twice in 2022 by 50 basis points, that would result in mortgage rates of around 2%, still low by historical standards.
For a property which costs around, say, 8 million, then actually you can get, say, 90% leverage from the bank. After the change of the interest rate by 50 basis points, actually you only need to pay 7% more on your mortgage repayment, which is only, say, 1,000, 2,000 something difference. I don't think that would be much impact to the existing households.
And it is not expected 2022 will bring a consolidation in land or flat prices. Current supply estimates for the next 10 years show the private sector will produce 12,900 new units per year, falling short of projected demand.
That means only the first-hand market, there are around 14,800 units transacted every year. So in case we can only provide, say, like 12,900 units per annum, it cannot even meet with the demand of the current first-hand sale. So that would be a concern.
Prices in 2022 are expected to continue to rise, a forecast 7%, with a cap of 10% for the period. The burden falls on the public sector housing providers to meet the demand for the majority of aspiring home seekers. On the economic front, central banks will have to recalibrate their policies in 2022 from one of economic stimulus amid the pandemic to inflation fighting, as improving economies in late 2021 created supply chain shortages and bottlenecks and price hikes. But conditions for increased borrowing costs aren't the same everywhere.
We distinguish two groups of central banks. The ones which most likely have to hike. We expect the Federal Reserve to have to hike interest rates in 2022, most likely by 3 times. The Bank of England as well, because they're suffering from a lot of inflationary pressures.
The rest of the world will be somewhat quieter. Analysts expect no changes from the European Central Bank, no change from the Bank of Japan, no change from the Swiss National Bank. The People's Bank of China may be forced to take a different path in 2022, as the national economy has hit a slow patch.
The PBOC has decided recently to lower the RRR ratio. We expect more of that to come. So you have a group of banks hiking, and then China, which most likely is going to be on the easing side.
The global economy is expected to remain on an expansionary track in 2022, barring another variant shock at 3.9%. For the other large economies, GDP estimates peg growth at around the 3% mark in 2022. Pictet Wealth Management forecasts are more optimistic. But it is the direction and speed of any interest rate movement that will dominate the fortunes of the stock markets.
The central banks cannot raise interest rates too fast, too quickly, but we would expect that to result in a rebalancing within equity markets. The equity markets today are split in two. You have one part which is the highly successful companies of the last years, namely the large tech companies, which valuations are very high. So de facto, their valuation should be influenced negatively by a rise in interest rates.
On the other side, cyclical stocks like the companies in the consumer sector will be relatively unscathed by interest rate increases, and since many trade at a discount, will be ripe for buying when tightening begins. All bets in 2022 will be off in the event of another more serious variant scare than the Omicron shock. China's small and medium-sized enterprises, SMEs, have maintained an overall steady recovery momentum this year, according to data released by the National Bureau of Statistics. In the first 10 months of 2021, the SMEs with annual revenue of more than 20 million yuan have registered a revenue increase of 21.5% year-on-year, or 9.7 percentage points higher than the average of the past 2 years. In the meanwhile, the total profits of the SMEs in January-October are also up 30.4% year-on-year, or a 17.4% increase compared with the average of the past 2 years. In October, the SMEs Development Index, based on a survey of 3,000 SMEs, registered 100.4%. The monthly data has maintained above a reading of 100, which indicates an upward trend in business.
Faced with a complicated and changing environment, China's SME have seen growth in revenue and profits of over 10% in the first 10 months of 2021, as production and business activity continue to maintain a stable recovery, which is very impressive. It shows that China has managed to bring the spread of the epidemic under control, while the country's economy has demonstrated strong resilience.
Chinese authorities have issued a series of policies to help small and medium-sized enterprises tide over difficulties during the pandemic and expand innovation and development.
When Money Matters returns, how landlords have been forced to deal with reality on Hong Kong Island. Stay with us. Welcome back to Money Matters. The unemployment rate in Hong Kong is coming down, signaling the local economy continues to improve. But the threat from new coronavirus variants has made landlords more cautious and willing to offer more reasonable rent to potential tenants. Alice Kahn continues her look at flats in Kennedy Town and one that's in a project located on the shores of Belcher Bay.
The swimming shed where visitors take photos or admire the scenic view. The original Saiwan swimming shed was built in the 1950s, offering locals a spot to relax and swim in the sea. In the early 90s, more swimming sheds were built along the seashore, but many have been demolished. Nowadays, this is the only remaining one in Hong Kong. This week, we search for a budget apartment that is not far away from the swimming shed, and just a few minutes walk from trendy restaurants.
Some people, they want a cheaper rental and also the convenience and the seaside. Then all those factors, they are anxious to move to this area. I would say compared to the other seasides like Repulse Bay area, and the Kennedy Town is much cheaper.
We checked out a flat in this 21-year-old project on the waterfront. Part of the project operates serviced apartments. It has 48 stories, offering 476 units. The size ranges from 434 to 714 square feet. 80% of residents in this building are expats. The rental level ranges from $22,000 up to $38,000 per month, which is lower than other buildings nearby. The flat we visited is a 476 square foot apartment. The landlord is asking $24,500 a month. Our agent, Jackie, showed us the layout.
The living room area is about 160 square foot.
It's quite practical.
Yes, it's quite square shape, so it's quite easy to put furniture.
Yeah, then how do you lay out the furniture?
You could simply put a sofa on this wall here, and then the TV cabinets on this wall, and also the obviously you can put a dining table at this corner.
As it was a serviced apartment, the finishing is good and interior well maintained.
The kitchen is nicely done, but the shape is irregular.
The landlord has been spent almost $200,000 to tailor-make all the cabinets and also to renovate the whole kitchen. by replacing the tiles, the range hood, the cooker head, and also replacing the fridge and the washing machine to try to make it nicely decorate to attract the tenants.
The flat has no corridors, so the efficiency is higher. It has just one bedroom.
Okay, Alice, this is the ensuite bedroom.
The ensuite bedroom is 133 square feet. The landlord offered a king-size bed for a tenant.
The king-size bed, you still have a room to rock around the bed.
Also, this room is not regular. You can see this, it's really hard to fit in any bedside table.
Yes, unfortunately, this has a triangle shape next to the bed. So you need to tailor-make a furniture to fit in this corner here.
The storage space is limited.
Jackie, are there any other furniture offered by the landlord?
The landlord offered this wardrobe here, which you can hang in clothes here and putting some stuff underneath. And then obviously you can put a suitcase on the top.
How about this side?
You do have more storage on this side, something you don't use regularly, and could put on top of the cabinet.
The ensuite bathroom is less than 40 square feet. The wall and the floor are made of marble. The marble wall separates the sink and the toilet and bathtub.
And Jackie, the bathroom is not big and also the shape is irregular. It's not user-friendly.
It's not irregular, but fortunately, it has all the equipment. For example, the bathtub, a lot of buildings in Hong Kong only have a shower stand instead of the bathtub. And also it has a lot of storage for shampoo, perfume.
Any visitors would need to use the ensuite bathroom, which is not ideal. The flat has big windows that brings in a lot of light. Also, since it is facing south, residents will feel warm in the winter.
But this building actually right next to the harbor, but
yes.
It doesn't have a sea view. It only has a mountain view and building view.
Yes, right now the landlord is asking for $24,500, but if the sea view, a similar size sea view unit, it will cost about $30,000.
Then is it the market rent?
I would say so because the previous tenants who pay $23,500 for this unit, and the recent transaction is about $24,000. And plus, if you're looking for a similar size in Wan Chai, you need to pay a lot more.
Amenity-wise, this project offers many facilities, including a big swimming pool, gym room, a sauna room, children's playground and function rooms. There's also a shuttle to Central. Jackie says the project will be attractive to buyers because the building is sitting on a plot with a 999-year land lease. In Hong Kong, virtually all land is leased from the government. In the early days, leases were for terms of 75, 99, or 999 years. During 1849 to 1898, land leases were 999 years upon application of landowners. Yet the former colonial government ceased to offer such long leases after May 1898, as it deprived government control of the land and potential revenue. Currently, there are many new projects in Saiwan built on land with a 999-year lease.
For the foreigner buyer, it's kind of like a freehold for them, so they find it's more value for the building.
Most of the land leases were granted for, say, 99 years or 75 years plus another 75 years. Of course, under the basic law, all the land grants which were expired before the 1997, actually the land grant would be renewed automatically up to 247, 1st of July of 247. But you have to pay 3% on rateable value as the government rent as a compensation for the renewal of the land grant. The leases were granted by the prevailing governor for a term of 999 years. For such type of the lease, the advantage is you don't need to pay the 3% government rent on rateable value basis to the government right now. So that means you can save some of the expenses.
Vincent says that many buyers feel more secure buying property on land with a 999-year lease.
And another thing is about the certainty of the land tenure. Because for such type of the lease, you will have a longer certainty compared to the new grant land by the government right now. Because now all the new grant land in Hong Kong is for a tenure of 50 years. So for some of the properties which are subject to 999-year lease term, their tenure may be even longer than the new grant lands by the Hong Kong government right now.
Next time, we continue our exploration for value living in the neighborhoods of Kennedy Town.
In the ex-Soviet nation of Georgia, the legacy of the dictator Joseph Stalin is a complicated one. 30 years after the collapse of the Soviet Union and the country's independence. For many, Stalin, who was born in Georgia, is a hero who led the Soviet Union to victory in World War II. For others, Stalin was a tyrant who presided over atrocities that took the lives of millions of citizens and thousands of Georgians through execution and deportation. In Gori, Stalin's hometown, locals continue to get riled up when talk turns to the area's most famous son.
Stalin is a part of history, and you cannot cross out history and cannot forget it. What is his legacy? He changed the world, whether you like it or not.
I don't think German people admire Hitler, and he did awful things, and so did Stalin. They did awful things on different scale.
The museum includes the house in which the leader was born. Many want the government to do more to re-examine the Soviet legacy. Experts say it is impossible to build a democratic and just state without understanding the past. In a striking display of consumerism clashing with nature's rawest climate, thousands of tons of knockoff clothing from Europe and the US are piled up in a mass dump of unwanted fast fashions in the remote vastness of Chile's Atacama Desert. The clandestine piles of clothing emerged after they were left behind by local merchants. A duty-free trade zone in the far north of Chile receives thousands of tons of used clothing bought by the traders. In the process of choosing the most attractive garments for sale, they discard what is left in this huge, unauthorized dump. Authorities say the country imported more than 59,000 tons of clothing and shoes in 2021, as they work to close the area and restore the desert to its previous condition.
That's the show. Thanks for watching. Next week, we look at the opportunities available in the metaverse. See you then. Good night.